last year, in around April 2013, the Fed Reserve gave their first real hints around their plans to taper their asset purchase program known as quantitative easing. Of course, it took them until around about January of 2014 to commence their tapering, and so this gave bond investors and the rest of the capital markets time to form a view on the issue. However, during this period, medium and longer dated sovereign bond yields in the US, along with much of the rest of the world, shifted higher. This of course carries swap rates and therefore debt fixing costs higher across most core Asian markets, although to varying degrees. Singapore and Hong Kong, given their monetary policy mechanisms, simulated US rates to move sharply higher over the back half of 2013. Interest rates in Korea and Australia at the longer end of the curve also moved marginally higher, and rates in China spiked, although this was for a number of other reasons, mostly related to concerns around credit expansion and a temporary lack of liquidity in their own domestic money markets. Japan, on the other hand, has been a market which has essentially been running its own race. As the rest of the world has been talking about cutbacks in quantitative easing and other stimulus measures, Japan has been in full swing with their own very large asset purchase program. So liquidity remains abundant in Japan, and bond rates have been on a one-way downward path. At the moment, longer dated bond rates in Japan are sitting at negative real interest rates. Therefore, I'm not sure how much longer it can last, unless of course the Bank of Japan keeps up the buying pressure. So what's been interesting this year is that since the tapering of QE has commenced, bond rates and swap rates have been much less volatile than what was initially anticipated. So really what has happened is that yield curves have steepened at the back end of last year, and we've seen essentially no upward pressure on longer term rates so far this year, and in fact in some markets there's been downward pressure in swap rates. There has been some talk around future interest rate rises and what sort of an impact that is having on the market now and what sort of an impact that's likely to have down the track. And at the moment what I think we're seeing are a number of offsetting factors, so market pricing remains fairly well balanced, but investors are perhaps taking more time to look through all of these factors. So on the one hand, we've seen a temporary slowdown in transaction volumes this year as vendors and purchasers are at a standoff over pricing, partly due, of course, to the uncertainty in the interest rate outlook. And on the other hand, we're starting to see some improvements in the corporate leasing markets, so rental growth is coming through in a number of core cities around Asia, and investors are therefore starting to position themselves for that forward earnings growth, especially as supply pipelines are relatively thin in most of these core markets at the moment. And I think rental growth is to be expected, as historically the drivers of interest rates are very closely aligned to the drivers of, say, office rents. In other words, things like employment growth, retail spending and business investment all have an impact on aggregate demand and inflation, and therefore they drive short-term interest rates. They are also the key drivers to corporate expansion and net absorption, so it's these periods of rising short-term interest rates where we tend to see most of the above-trend take-up rates. I think one point to make though is that we are going to reach the end of these historically low interest rates at some time over the next few years. So down the track there could be some pressure on yields. However, yields do remain at a strong premium over the cost of debt in most Asian markets, so there is a natural buffer to these pricing metrics, and the rental growth outlook in each individual market will be the key determinant in yield movements. There has also been another offsetting factor on the interest rate front, and that of course has been typical lending margins. Since the fallout from the financial crisis, lending margins have stabilised, however they do sit much wider to the curve than they initially did prior to the financial crisis. So we have seen margins tighten across Asian markets from anywhere between around about 30 to 100 basis points over the past few years, but I think there certainly remains further scope for these margins to tighten, which will continue to offer an offset to higher future interest rates. I think that while banks do and will continue to dominate the lending environment around Asia, we are starting to see some positive signs in the alternative lending space. Of course, most large institutional grade investors are taking a more active role in these non-banking lending markets, both to diversify their funding sources in order to reduce their refinance risk, as well as to gain access to longer maturities, favourable loan to value ratios and other flexibility related terms on offer. And the banks are also under pressure in the face of new regulation, such as Basel III, and are looking to hold less of these riskier real estate loans on their own balance sheet. So what they're doing is that what they like to call originate and syndicate, meaning the banks continue to originate and underwrite these loans, but they're starting to shift them off their own balance sheet by either securitising the loans or syndicating them and selling them down to their own clients. Corporates are also seeing some benefits to tapping these alternative debt markets, with a number of new groups looking for opportunities, particularly in the medium-term note space, primarily due to the flexibility in which they offer. Recently, there has also been some strong appetite across Asia from both fund managers and private banks seeking out shorter duration, high-yield securitised debt in the real estate sector. Private banks have shown overwhelming demand for these high-yield instruments, which of course is pushing yields in the secondary market lower and drawing interest from new players who now are starting to see this as an alternative source of funds.